Talking about some of the things that you can do to help improve your finances right out of the gate, to start the year off with some positive traction for improving your financial health. One of the things that we were talking about before the break is this split, if you will, between what savings is earning depending upon where you're going. And what's interesting is when you look at the largest banking institutions, they really haven't changed their savings rates, if you will, all that much in light of the fact that interest rates really have climbed dramatically during the course of 2022. As we were saying before, if you look at the 5 largest banks, customers there could have earned almost $42 billion more by simply shopping around in terms of their savings rates and looking for higher yielding savings rates on their money. Online, you can certainly find them at 4%. Money market mutual funds, which aren't FDI insured, that's the caveat on those, but the reality is that they're at 4% as well. So if you look at the average large banking institution that's still paying 0.268% on its savings account, it's probably worth doing a little bit of homework to say, you know what, I'm going to move that around and try and capture a little bit more on that interest rate. Now, the reality is, even if you get to 4%, you're not exactly getting rich on that, but at least it's some protection against all of the inflation. Another option that a lot of folks talk about, and here at the beginning of the year, you can do it again, is the I-bond option. You're limited to $10,000 annually that you can do, but those are backed by the U.S. government, and generally that's viewed as sort of the gold standard, if you will, although, you know, it is running a deficit of about $27 trillion. But hey, set that aside for just a second. The I-bonds today currently at almost 6.9%. Big caveat, of course, on all of this is be careful. I think far too often people load up their savings, have really kind of too much in cash, still need to have some growth, still need to have some diversification, still need to have some balance in that overall investment picture. But particularly when it comes to cash today, savings today, there are definitely makes a lot of sense to shop around because there's definitely some big spreads, probably the biggest spreads that we've seen on kind of what some banking institutions are offering in terms of savings rates versus what actually is available out there. So welcome back into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out there. Subscribe to us on your favorite podcast platform of choice, or go to our YouTube channel as well. Simply look for Nelson Financial Planning, Dollars and Cents with Joel Garris. If you have any trouble locating our channel on your favorite platform, go to our website, nelsonfinancialplanning.com, and you will see in the upper right-hand corner a bunch of icons. Click on the one that looks most familiar to you, and you will wind up getting connected directly to our channel. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries, certified financial planners, CPAs, IRS enrolled agents, we got everybody as part of the team to provide that holistic approach to help you understand and improve your overall finances. Give us a call this week, 407-629-6477, to set up an absolutely free conversation with folks on the team. More than happy to help you see if we can improve your financial picture. So one of the things that we're talking about on the program, of course, is ways that you can improve your financial picture. We talked a little bit about shopping around for savings account. This next one sort of goes hand in hand with that first one, and that is to really, while you're kind of shopping savings rate, maybe you should also look at your bank account and the features that are associated with that. Banking, much like every industry has dramatically changed over the course of the past 2 decades. But chances are your bank hasn't really been offering you the latest and greatest benefits to being an account holder with them. Why? Well, because Americans typically, on average, stick with the same primary checking and savings account for about 17 years. So Americans are sticking with their savings account and checking accounts like way longer than what the average marriage is. 17 years is the average length of time that the typical American stays with its primary checking and savings accounts. And the reality is, the truth is, the bank knows that. And at the end of the day, you may think that you're getting the best possible deal, the best possible overdraft protection, the lowest fees, the best maintenance, and whatever the case may be. It's probably unlikely that you are. So as with anything, particularly on the banking side, probably makes sense to do a little shopping around, if you will, on that. Who knows, might find that you're not having to pay as much in terms of some of the fees that these banking institutions charge these days. Number 3, speaking of institutions that charge, take a moment and check out your monthly subscriptions. I, for one, am certainly guilty of this. But the reality is that monthly subscriptions are a huge part of how we live now, right? Think 30 years ago, right? What was the monthly subscription that you had then? Like to the local YMCA? I mean, that was kind of it. I mean, maybe it was one other, but not the numbers that you have today. The average American today has, just for media and entertainment, I'm not talking like the Y, just media and entertainment, the average American today has 12 different monthly subscriptions. It is staggering. Average millennial, that number goes to 17 monthly subscriptions. Start of the year, of course, everybody's adding in a gym membership. Maybe you want to look at some of those subscriptions that then are carrying over from last year, because I doubt you are using all of them. Those costs can certainly add up. Average American spends somewhere over $200 per month on subscriptions. And by the way, according to surveys, underestimates that cost by about $130. Y'all think that you're not paying that much on subscriptions, but lo and behold, you are. 75% of Americans say it's easy to forget, and nearly half admit paying for something that they don't even use. Of course, the other half probably doesn't even remember that they have the subscription in the first place. But pretty sure we can say a lot of Americans are paying for stuff that they don't use, particularly in this monthly subscription landscape, because it's easy to sign up. If you've ever done it, it's easy to sign up. But at the same point in time, it's a lot harder to cancel these things. And they know that, and they do that. And that's the way it goes, because the companies that do this know that there's a lot of inertia out there, right? It's only natural that there be inertia, and so consequently, let's just keep the subscription going, and at the end of the day, they're going to continue to collect money. So this one, I think, is in the very definition, or the very category of wasting money. And again, we're not talking about big things here to start the year off. We're not talking about changing your behavior, although you probably want to do that if the finances aren't in good shape. We're just talking about very simple things that just sort of require you to do a little bit of homework, but don't necessarily change what you're doing, right? Looking for a bank that's got a better savings rate, looking for a bank that might be offering a better deal in terms of fees or maintenance costs or things like that. Taking a look at all of those monthly subscriptions that you've got and figuring out, first of all, which ones you got and which ones you're not really using, and then going through the process of canceling them. We got a bunch more of these thoughts that we want to share with you. We're going to bank that, though, for next week's program, because we're coming up on the back half of the program. We want to get Kristen Cayley into the studio here at Nelson Financial Planning and talk about some of these tax changes that happened or got jammed into the budget bill in the last week of 2022. So that's coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Joining us in the second half of the program here on Dollars and Cents with Joel Garris of Nelson Financial Planning, Kristen Cayley of Nelson Financial Planning, also a fellow certified financial planner, fellow certified financial fiduciary. But what is unique about Kristen is that she is also a CPA. Welcome to the program.
Thanks, Joel. Happy to be here.
So the folks in Washington threw a bunch of stuff in this budget bill that they passed at the end of last year.
Mm-hmm. Yep.
And once again, I doubt very seriously that they actually read it.
I agree with that. Certain provisions don't make too much sense.
And so that's part of what you've been doing this past week, is trying to get through some of the details, if you will, on it. So let's start with sort of the biggest highlight that has made a lot of the headlines so far, and that has to deal with required minimum distributions.
Mm-hmm. Yep. So the Secure Act 2.0 actually increased the RMD age from 72 to 73.
And that applies for 2023.
Correct.
So if you were fortunate enough to kind of be born in 1950, then because they keep bumping the age up, then you've been able to dodge a required minimum distribution for a couple of years now because they keep throwing the age up.
Mm-hmm.
So that's interesting. But of course, if you were born in 1950 or before, if I'm doing the math right in my head, then you've got the required minimum distribution.
Yeah, starting this year, 2023.
But there is some good news on that if you are not paying attention, because they also changed the penalty.
They did. They actually decreased it quite a bit. So it used to be 50% if you missed RMD distribution, but now it's down to 25%, and in some cases it can even be 10%.
So what's that situation where you wind up, because that's like a special deal, if you will, where that penalty, because the 50% penalty, folks, was I think one of the most draconian penalties in the entire tax code. When you stop and think about, okay, if I don't take a required distribution, I'm going to get hit with a 50% penalty. Oh, by the way, it's also taxable. I mean, if you're in a high tax bracket, there goes 80-90% of the entire amount of money.
Mm-hmm.
The only good news on that is that generally we saw that was not a highly enforced penalty. But so that's the marginally good news. The bad news that comes with the reduced penalty is I suspect that they may be looking to increase enforcement then.
Right. There is that one situation where you can get a 10% penalty if you miss the RMD, but you have to take it within the next year. So if you miss it for 2023, so long as you take it in 2024, you can get that penalty reduced to 10%.
So that is good. A little bit of a correction allows the taxpayer to sort of correct the mistake and not slap them too much on the wrist in terms of that required minimum distribution. So the required minimum distribution age goes to 73. If you're a beneficiary of an IRA, though, what's the deal there? Because that's a different set of rules.
Yeah, so that actually just changed as well. So we were talking about it on a couple of previous shows where we thought with the inherited RMDs that you had the 10-year period to liquidate the account as you wanted. But now we found out that beginning in 2023, you actually have to take an RMD each year within that 10-year period and also liquidate the full account.
So this goes to the new rules that happen post-2020 that deal with when you inherit an IRA, you no longer get the ability to spread that out over the course of your lifetime like you used to. Now, obviously, if you are a spouse, different set of rules apply. You can assume that as your own. We're talking about non-spousal beneficiaries prior to 2020 had the ability to take that out over the rest of their lifetime. 2020 changed that, said 10-year rule. Mm-hmm. There wasn't a lot of specificity, so a lot of folks were saying, well, then you've got 10 years to do it. So you could wait to year 6 and then start, depending upon where you were in terms of your retirement journey, maybe you get some flexibility, but that's not the entire case in terms of that flexibility.
Right. So now if you are one of those people that fall into that category where you inherited an account after 2020 or during 2020, you have to take an RMD each year.
But that doesn't mean now the RMD is based upon what? Is it based upon my life, account owner's life? Kind of what is that? How does that break down?
I believe it's based upon your life, but we need some more regulations to
figure out exactly what that is. But the good news is then, though, that it's just a required minimum amount. It's not like it equates to 10% of the account.
Right.
So there is still some flexibility for someone to say, okay, I got to take my minimum amount out, but I can push a lot of that to a little bit later on if I wanted to.
Exactly. Yep.
So that's at least some flexibility. Now, the IRS has issued some guidance on this that gives people an out if they haven't done this the way that they now say that they need to do.
Mm-hmm. Yep. So if you did not take an RMD the past 3 years, if you inherited the account in 2020, there is relief for each of those years. So you don't need to go back and make up any missed RMDs, just starting moving forward. In 2023, you need to start taking those RMDs.
So you sort of get a pass if you were kind of operating under the assumption that well, the rules weren't clear and you were waiting on them to actually come out with some real guidance. They're not going to penalize you. That's good that they're not going to penalize you for being completely unclear in terms of their rules that they have with respect to these required minimum distributions. One more thing back to the required minimum distribution age. There was also another piece in there that we want to share with our listeners. What was that piece, Kristen?
So the age for the qualified charitable distributions, it has not changed. It still remains at 70 and a half, which was what it was before the Secure Act passed back in 2020. So that still stays the same. So you can make a QCD as long as you're over 70 and a half. And
that's a great way to be able to donate to a charity, get the immediate write-off in terms of the taxation of that income. Really an option that we advocate strongly for those that are charitable-minded at the office, because why not? I mean, otherwise, a lot of people don't get the charitable write-off like they used to, particularly with the much higher standard deduction, which I guess is the good segue to the other thing that happened in terms of the changes for the course of the past year. Yeah. So there's been some changes to charitable contributions. So for the past 2 years, we were able to take a above-the-line charitable distribution or charitable deduction, and that was available to everybody. So either if you didn't itemize or you just took the standard, you would be able to take this deduction. It's a pretty small amount. It was $300 for single filers and $600 for married filers, but it was still something that you could get a deduction for making those contributions. At least something that said, okay, if I give money to a charity, I'm going to get some tax savings. And not that that is the end-all, be-all for most people who donate to charity, but it's a nice little kicker, right? That if you're donating to a charity, you wind up getting a tax savings on that. Obviously, that goes away, which is unfortunate because a lot of people these days with the much higher standard deduction find that they're simply not able to get a tax write-off directly for those charitable contributions. Only way to really do that, and that's why the qualified charitable distribution from an IRA as part of your required minimum distribution is such a big issue. On the required minimum distribution, there was also something in there that pushed the age up even later in later years, right? So they've already got it pegged. So we're going to 73 for the year 2023, but then they've also got it pegged to do a different year, a different age going forward. Yeah, so there's a 10-year period that it's going to stay at age 73, and then starting in 2033, it's going to increase from 73 to 75. Yeah, so that's kind of weird. I mean, and obviously we're talking about a bill that came out of Washington, so everything there is weird, but I just don't understand why you wait 10 years. I mean, here we are, and it's like 3 years in a row where they've increased the required minimum distribution age from 70 and a half to 73. Huge jump within a very, very short period of time. Now we're going to wait 10 years, and then it's going to go up by 2 years. Why isn't there like 5 years it goes to 74, and then... anyway. I don't know. Your guess is as good as mine. Well, and I think a lot of folks in Washington are doing just that in terms of projections and finances and a lot of these bills that get passed. So, well, that's the side on the required minimum distribution. What about limits to like 401ks, things like that? Those obviously changed, but that was more related to inflation then. Right. Those all went up. So we're going to, when we come back from the break, we're going to talk about about those higher contribution limits for things like 401ks, health savings accounts, all of that when we continue here on Dollars and Cents with Joel Garrison, Kristen Cayley of Nelson Financial Planning. Welcome to the program, ladies and gentlemen. Talking about some of the big tax changes that happened, a lot of which got stuck into that budget bill that the folks in Washington passed in the last week of 2022. But many of those are provisions that sort of expire. So when you look at the news release that the IRS did in November, sort of preparing taxpayers for the upcoming season, that their refund, whatever the refund was that they got this past year, it's not going to be the same. And that's going to be a surprise to many. So what were some of the things that sort of disappeared, if you will, for this year, 2022 versus prior 2021?
So the big one is no more stimulus checks.
Right.
So that's not going to be on the tax return anymore, as well as the advanced child tax credit. Those were the payments that came to families early. So instead of getting a refund for it, you receive those payments for 6 months before you owed your taxes. And then also that above-the-line charitable deduction that we just spoke about. So that's also being eliminated.
So big stuff that was a part of your tax return for a couple of years, probably at the end of the day gave people maybe a little bit of a false sense of security as to what their tax picture ultimately looked like. None of that got renewed. It all sort of disappeared. And then to compound things, if you do wind up owing money, we've got some bad news for taxpayers.
Yeah, unfortunately, the underpayment penalty has gone up. So it was at 4%, and it's now at 6% for the 2022 tax year.
Direct reflection of where interest rates are. Those penalties apply to those interest rates that the IRS charges directly correlated to where prevailing interest rates are. And what does that have to do with that? When would I be hit with that kind of an interest charge on my tax return?
So that's when you file it. So when you go to prepare your taxes, that's where the penalty is calculated. It's on Form 2210, and it's just a calculation that's run on your tax software or TurboTax, and it spits out when you owe a penalty, it is included in your payment.
Because the reality is, as a taxpayer, I'm supposed to be paying the IRS my taxes along the way, and if I am short, then they don't like that.
No, they want their money ahead of time. It's a pay-as-you-go type of system.
And if you don't pay as you go, then that's where the interest rate comes into play. Hasn't been that big of a deal for many Americans for many, many years because interest rates are so low. But now you've got higher interest rates. And then you have the expiration of all of these stimulus checks, child tax credits, dependent care credit, all of that. The dependent care one was also an equally big tax credit. All of that is gone. So folks are going to be stuck with sort of the reality of some big changes on their tax return.
Yeah, and there's not much you can do now for the 2022 tax year, but also keep in mind it's going to increase for the 2023 tax year from 6% to 7%. So if you haven't been doing enough withholding, this year's might be the year to bump all that up.
So first half of the program, we talk about some of the things that taxpayers can do to help improve their finances. That would certainly be one that we would want to add to the list. Check your tax withholding. Make sure you've got enough going into the system.
Yeah.
Otherwise, the penalty jumps to 7% for this year. So that's pretty significant. Speaking of things to check at work, let's go to retirement plan contributions. Where did those go this past year?
So most of your retirement accounts are employers, so accounts such as 401ks, 403bs, 457 plans. So all of those increased from $20,500 to $22,500.
So a pretty big increase. As I understand it, that was probably the biggest increase in percentage and also magnitude. Again, correlated more to inflation than anything at all.
Right. Right, and also the catch-up increase too. It went from $6,500 to $7,500. So if you're over age 50, you could put in $30,000 into your 401k, 403b accounts. Yeah,
pretty healthy amount that those have gotten up to. Certainly not the days of 7,500 or 8,500, which was applicable many years back. What about regular IRA and Roths? What's the story there?
So those increased a little bit. So they went from $6,000 to $6,500.
Okay. All right. So you can put a little bit more. What about the catch-up there? Did anything happen there?
No, it remains the same at $1,000 for age 50 and older.
Okay. So if I'm over 50, the maximum IRA Roth contribution I can make is winds up being $7,500 for the year. Okay. So important for taxpayers to know that. It's no longer that $7,000. It's actually crept up to $7,500. And then HSA, what about that?
HSA, so if you are an individual plan, it went from $3,650 to $3,850.
So a little bit of a bump there. Yeah. HSA, obviously health savings account. Great vehicle for saving for healthcare costs. Very different than your typical flex plan. Your flex plan bought dollars, those always expire at the end of the year. The HSA does not. It rolls over. And in fact, there's some provisions that allow you to use it in retirement as well. But, and a big exception there is, you've got to have a high deductible health insurance plan that you are on in order to have an HSA. It's not like you and I can run out and just willy-nilly get an HSA.
Right.
Got to have the right health insurance plan that matches with that HSA. So, we got a lot to talk about here. We're going to have you rejoin us next week as well. But let's get to something that you and I had a lot of conversation about a month or so ago, and that has to deal with this 1099K, this Ticketmaster, this Etsy stuff. Tell us about what the story is on that, because that's a pretty significant one.
Yeah, so I feel like the IRS maybe heard some of our complaints and fears about what was happening with Form 1099K. So that was for the third-party payment processors, so the platforms such as Venmo, PayPal, even Ticketmaster for reselling tickets. So they were now going to be required to issue Form 1099K for payments of $600 or more.
On a single transaction.
Exactly.
I mean, it wasn't a single transaction of more than 600 or however many transactions, but just an incredibly low amount.
And people were worried that their Venmo transactions, where they were just sending money for splitting bills, splitting dinner, something along those lines, would trigger a Form 1099K. But we have some good news, is that it has been postponed to starting in the 2023 tax year. It's income tax return, so it's not going to start this year on your tax return, but next year.
Yeah, so that once again, they kicked it down the road, but there's going to be a lot more to talk about on that, because I don't think they're going to move off of that. And some people would argue that they can't even really move from that, because the $600 threshold was part of a bill, a legislation that passed Congress. That's part of the law. So some people are raising the question of whether the IRS could even sort of do it, delay it, but they have, and I think that's a win certainly for taxpayers.
Yeah, it'll make it a little easier this tax season, just a little.
It also means, though, the message there clearly, Kristen, for taxpayers is you better start using this year as an introduction to kind of keeping track of that in a much, you kind of dodged the bullet. If you didn't have your act together and weren't really tracking this stuff all that well last year, you dodged the bullet. This year, you better have good records on that.
Yeah, you don't want to double count income. So if you have your own business and you're counting income and then you have a 1099K, you don't want to double count. So good things to kind of keep your eye out for.
Well, and certainly the burden, as we've always said, the burden of anything is always on the taxpayer. So you better have your act together on that. All right, well, as I suspected, we got much more to talk about in terms of tax changes. So we got to wrap it on up and get on out of here. Kristen's going to join us next week for a continued conversation of these tax changes. Certainly, if you like what you heard on this week's episode of Dollars and Cents with the team here at Nelson Financial Planning, reach out to us through our website at nelsonfinancialplanning.com. Happy to schedule a free consultation to see how we might help you improve your financial life. Or you can call the office at 407-629-6477. Have a great rest of your day.